Okay, let's unpack this.
Right. So today we're doing a deep dive into a really fascinating corporate shift. We're talking about GFL Environmental Inc., the fourth largest environmental services company in North America.
Yeah,
Yeah.
GFL. And they did something pretty radical in early 2025.
Totally radical. It wasn't just like a minor tweak.
No, we're talking a foundational change. They sold off their entire environmental services division. I mean, that was a huge part of their business.
Huge. And for a staggering amount, $8.0 billion enterprise value.
Exactly. And that one deal just completely reshaped the company. Took it from this complex, highly leveraged operation and turned it into what the market likes to call a solid waste pure play.
And that's our mission today, really, to understand the physics of that pivot. Why shed a massive chunk of revenue like that?
How does $8 billion in cash change everything for them?
Yeah, their whole growth story.
Yeah.
And crucially, why this pivot sets up what could be a really compelling investment case. Some people are calling it a potential double play return.
Double play meaning what, you get growth and a valuation bump.
Exactly. Better earnings growth than maybe people expect, plus the market potentially valuing those earnings more highly down the road.
Okay. So if you want a shortcut to understanding like the nuts and bolts of the North American waste business, which is super defensive, by the way,
Oh, incredibly defensive.
and how companies grow by buying up smaller guys, the whole M&A consolidation thing.
Which GFL is a master at.
Right. And maybe the most surprising bit, how these sustainability projects, like making fuel from landfill gas, have actually become real profit centers.
Yeah, high margin profit centers, believe it or not.
Then you are definitely in the right place. So let's start with that foundation. What makes this solid waste business tick?
Well, before the sale, GFL, they're based up in Vaughan, Ontario, right? They had already built up this enormous scale across Canada and deep into the U.S. Yeah, operations across Canada, and I think the number was 18 U.S. states. So a really significant footprint. And they were known for being diversified solid waste, sure, but also infrastructure work, other environmental stuff.
But that diversification, it added complexity, didn't it?
It did. And the core business, the solid waste part they decided to keep, well, it operates with these incredibly powerful, almost unique economic characteristics. You mentioned the moat earlier.
Yeah, the industry moat. Why is this service, which seems so basic, actually so protected?
It really boils down to being essential, completely non-discretionary. I mean, think about it. Boom times, recession, doesn't matter.
People make trash. Businesses make trash every single day.
Exactly. That consistency makes the revenue just incredibly predictable, stable, resilient. It's pretty much the ultimate defensive revenue stream you can find.
Okay, stable revenue, great. But what stops competition? Those high barriers to entry must be key to turning stability into profit, right? You can't just, rent some trucks and start a GFL competitor tomorrow.
No way. You need massive, massive capital just for the fleets of trucks, the transfer stations, the sorting facilities, what they call MRFs, material recovery facilities. It's a huge investment.
Okay, trucks and facilities, big checks. But what's the biggest barrier?
The biggest, the most formidable, the one that really defines the whole industry. That's the landfill advantage.
Right. Let's spend a second on that because it sounds like the ultimate strategic weapon in this business.
It really is. Landfills are basically localized monopolies. Why? Because getting a permit for a new landfill, forget about it easily.
IMBY, right? Not in my backyard, plus regulations.
Precisely. Stringent environmental rules, zoning fights, public opposition. It can literally take decades to get a new landfill permitted. We're talking 10, 20, sometimes even 30 years of battling through red tape.
Wow. Decades.
So once a company like GFL owns a network of already permitted operational landfills, they essentially control the disposal capacity in that region. And that's the most critical, most difficult part of the entire value chain.
So GFL picks up my trash, drives it, and instead of paying someone else to dump it,
They dump it in their own landfill.
they dump it in their own hole in the ground. And that captures way more profit. That's internalization, right?
That's internalization. It's the magic word here. It's the difference between just being a trucking company moving waste around and being a high-margin infrastructure business.
Because if they had to pay a competitor for landfill space,
They lose margin. Simple as that. By internalizing the waste into their own network, they capture that entire disposal profit stream. Plus, it guarantees them long-term, low-cost disposal options. It maximizes the value of everything else they do. It's the structural advantage that really separates the big four from the thousands of smaller guys.
okay, understanding that core defensive, high barriers, high margins from internalization, It really helps explain the logic behind that big pivot, doesn't it? Why keep the complex, maybe lower margin environmental services stuff
Right, things like liquid waste or maybe some infrastructure
when
services.
that solid waste core is so inherently profitable and stable?
Exactly. The sources suggest that Environmental Services Division, I mean, yeah, it brought in revenue, but it was definitely more cyclical, sometimes lower margin, and it just added a lot of complexity, especially to the balance sheet.
So selling it off March 1st, 2025 for that $8 billion.
Correct. $8.0 billion enterprise value.
It did two massive things at once: extreme simplification
Get focused.
and massive deleveraging.
Yeah.
Pay down that debt. They basically went from being this kind of sprawling, complex holding company
Yeah.
to a streamlined, pure-play, solid waste company. Much easier for investors and the management, frankly, to understand and run.
So what does the new GFL look like now? After the sale, what's the revenue mix?
Yeah, so the remaining business is really tightly focused on that non-hazardous solid waste, but it's still nicely diversified across different types of customers.
Okay.
About 27% is commercial collection, think dumpsters behind stores and businesses. Another 24% is residential collection, like your curbside pickup. 19% is industrial collection, so manufacturing sites, construction maybe.
And the landfills themselves. Crucially, about 12% of the revenue comes directly from operating those landfills, the tipping fees they charge others, essentially.
So it's a good spread, not just relying on homeowners or just businesses. And they kept control of that high-margin disposal piece.
Absolutely. Spread the stable revenue across the whole economy, but keep that critical, profitable endpoint in-house.
Okay, so GFL simplifies. But the story of GFL, historically at least, has always been about growth.
Right.
And that growth came from just buying everything in sight, acquisitions.
An insatiable appetite is a good way to put it. Since their IPO back in 2020, they've executed and, importantly, integrated over 270 acquisitions.
270, that number is just staggering.
It really is. And that volume of deals, mostly what they call tuck-in acquisitions, that's been the main way GFL has grown and increased its density in all those regions they operate in.
So tuck-ins means smaller local companies.
Exactly. Despite the fact that you have these giants, the big four, dominating nationally, the waste market is still incredibly fragmented when you look town by town, region by region. There are literally thousands of small, private, often family-owned waste haulers out there.
Okay, but I have to jump in here. 270 acquisitions. I mean, that sounds less like a smooth strategy and more like, well, maybe organized chaos.
Yeah.
Isn't there a huge risk they overpaid for a lot of these smaller guys? Maybe inherited businesses that weren't run very well, systems that don't talk to each other.
That's absolutely the critical question, the skeptical lens you have to apply. The argument for GFL, the bull case, is that they've developed a proven, repeatable playbook for this.
Okay.
They aren't buying massive public companies. They're buying these small private haulers, the tuck-ins, and they immediately plug them into their existing larger regional network.
So the logic is, buy the small guy.
Right.
Fold their routes into GFL's denser routes to save on fuel and labor.
Make it more efficient.
And then, critically, funnel all that newly acquired trash volume into GFL's own high-margin landfills, not the competitors down the street.
That's the synergy playbook in a nutshell. That's how they argue the acquired companies generate a much higher return on invested capital inside GFL than they ever could on their own. That's how they justify paying a premium for them.
Okay, that makes sense. And they're not stopping.
Far from it. Management has been very clear. They plan to keep deploying significant capital, somewhere between $700 million and $900 million every year, on more tuck-in acquisitions going forward.
So that M&A is still a core part of the future growth story. It's like a built-in volume growth engine that maybe their bigger competitors don't have to the same degree anymore.
Exactly. It's a major source of future growth that sets them apart.
And when you look at the industry structure, you see why they need it, maybe. They're number 4.
Right. The competitive landscape is dominated by the big four. You've got Waste Management, WM, the giant, with about 35% market share. Republic Services, RSG, is number 2 at 26%. Waste Connections, WCN, number 3 at 14%.
And then GFL, post-divestiture, sits at around 9.4%. Smallest of the big guys.
Smallest, but historically the fastest grower by a mile, largely because of that M&A strategy.
You have the numbers on that growth difference.
Look at the historical revenue growth rates, the Kaji compound annual growth rate. GFL's was nearly 20%, 19.87% to be exact.
Wow.
Compare that to WM at just under 10%, 9.87%, RSG around 14.35%, and WCN at 14.28%. In a mature defensive industry like waste, growing almost twice as fast as the leader, that's astronomical.
Okay, so GFL bought its way to superior top-line growth. But as you hinted earlier, that aggressive strategy came with a catch, right? Lower operating margins.
Exactly. And this brings us to the absolute core of the investment opportunity now, closing that margin gap.
This is where the thesis really lives or dies.
It is. For the full year 2024, GFL's adjusted EBITDA margin, that's a key profit metric, was 28.6%. Now compare that to their key peers. Waste Connections, WCN, was up at 32.5%. Republic RSG was 31.1%.
So a gap of roughly 3 to 4 percentage points, that's significant.
It's very significant, and that gap has been the main reason GFL's stock has historically traded at a discount to companies like WCN.
Right. The market basically said, great growth, but less profitable growth.
But the argument now, post-pivot, is that this margin gap isn't some fundamental flaw in their business model. It's more like an artifact of that super fast growth.
A temporary consequence of swallowing 270 companies.
Correct. When you integrate that many businesses, especially smaller ones, you inevitably, temporarily inherit their lower margins, their less efficient ways of doing things.
So the opportunity now is to fix that, to bring those acquired assets up to GFL's standards.
Exactly. The strategic focus shifts from just buying to buying and optimizing. That margin gap, that's the prize. If GFL can get its overall margins up into the low 30s, like its peers,
then every dollar of revenue they already have suddenly becomes more profitable.
Right. It drops more profit straight to the bottom line. That would compound their already faster revenue growth rate. It's powerful leverage.
Okay, that's the theory. Do we have any hard proof, any tangible evidence that they're actually doing it, that they're closing the gap since the big sale?
We do, and this is absolutely critical because this is a show-me story for the market. In the fourth quarter of 2024, so right before the final sale closed, but reflecting the focus on the core solid waste business, their solid waste adjusted EBITDA margin expanded by a remarkable 270 basis points compared to the year before. It hit 33.4% for that specific quarter.
Wow, 270 basis points. That's almost 3 percentage points in 1 year. That's huge. That's proof of concept right there.
It really is. It shows the potential is real.
So how are they getting that kind of rapid improvement? You mentioned an enterprise transformation team. What are they actually doing on the ground?
Yeah, this is a dedicated internal team, and their whole job is basically standardization and squeezing out inefficiencies by leveraging GFL's scale.
Okay, like what specifically?
Big things. Centralized procurement, for one. Instead of each little acquired company buying its own fuel, tires, truck parts.
GFL buys for everyone, gets massive volume discounts?
Exactly. That's huge savings right there. They're also rolling out sophisticated route optimization software across the board.
Which sounds boring, but in the trash business, route density is everything, right?
Everything. You want to maximize the amount of waste you collect for every single mile driven. Less fuel, less labor time per pickup. It drops straight to the bottom line. Route optimization is paramount.
Makes sense. Anything else?
They're also aggressively converting their truck fleet, moving away from higher cost, higher maintenance diesel engines
to compressed natural gas, CNG.
Exactly, CNG. It's a big capital investment up front to convert the trucks and build fueling stations, but the payback comes from significantly lower fuel costs and lower maintenance over the life of the truck.
So procurement, routes, fleet conversion, it's a multi-pronged attack on cost.
It is. And management isn't shy about their goal. They're targeting long-term margins settling in the low to mid-30% range, if they hit that.
If they hit that, the market has to take notice. They'd have peer-level efficiency plus that faster growth.
That's the core thesis. So beyond the M&A engine and that internal cleanup on margins, the waste industry itself just has these amazing built-in advantages. Specifically, this almost unique ability to use pricing power to stay ahead of inflation.
Right. This is a huge plus for any essential service. How does GFL actually make sure their prices go up faster than their own costs, fuel, labor, etc.?
It's largely contractual,
Yeah.
especially when you look at their contracts with municipalities or big commercial customers. Many of those agreements have specific clauses built right in.
Clauses that guarantee price increases.
Often, yes. Annual price increases might be explicitly tied to an inflation index, like the Consumer Price Index, CPI. So if CPI goes up 4%, their price automatically goes up 4%, or maybe even a bit more.
Okay, that protects against general inflation.
What?
What about volatile costs, like fuel? Diesel prices go crazy sometimes.
They're protected there too, usually. Most contracts allow them to implement fuel surcharges. So if fuel costs spike, that extra cost gets passed directly through to the customer as a separate line item on the bill.
So they're not just eating inflation hoping things get better. The contract are structured to push those cost increases through, maintaining what they call a positive price-cost spread.
Exactly. They aim to raise prices slightly more than their costs increase. And this isn't just talk, you see it in their planning. For 2025, management was very explicit. They guided for core price increases between 5.25% and 5.5%.
Okay, and what do they expect costs to do?
They projected their internal cost inflation would be in the low to mid 4% range.
So price up 5 point something, costs up 4 point something. That difference, that positive spread, that's built-in margin expansion right there.
Absolutely. It provides this steady structural growth lever, almost regardless of what the broader economy is doing. It's very powerful.
Okay, so M&A for volume, margin cleanup for efficiency, pricing power for inflation protection. What else? Let's talk about this sustainability angle, because that feels genuinely new and, frankly, fascinating. Sustainability usually sounds like a cost center, a compliance headache.
It used to be viewed that way, maybe, but now it's become a major high-margin profit driver. It's a real game changer for GFL and the whole sector, actually.
Okay, how? What are the pieces here?
It's primarily two big things that are driving this. First is renewable natural gas, or RNG. Second is something called extended producer responsibility, or EPR. And the beauty is both of these leverage assets GFL already has, namely their landfills and their recycling facilities.
Okay, start with RNG, renewable natural gas. How do you turn rotting trash into a profit center? They're projecting, what, $175 million in extra EBITDA from this?
Yeah, $175 million in annual adjusted EBITDA starting around 2028. It's a big number. And here's how it works. Landfills naturally produce landfill gas as the organic waste decomposes. That gas is mostly methane.
Which is a potent greenhouse gas. Bad stuff if it just vents into the atmosphere.
Exactly. So GFL is investing capital to build systems to capture that methane gas. Then they process it, clean it up, and turn it into pipeline-quality renewable natural gas. It can be used just like fossil natural gas, but it's derived from waste.
Okay, capturing methane, cleaning it up, that requires investment, right? Collection wells, processing plants.
Oh, yeah, significant capital investment. But the returns are expected to be really robust, and here's why. They benefit from what you could call a triple revenue stack.
A triple revenue stack.
Okay.
Okay, break that down. What's stack number one?
Stack one is the simplest. They sell the physical gas itself. They inject it into the existing natural gas pipeline system and get paid for the energy content, just like any other gas producer.
Okay, sell the gas. Makes sense. What's stack two? You said this is where the high margin comes in.
Yes. Stack two is selling the environmental attributes associated with that gas. Because it's renewable and captures methane, it generates valuable environmental credits. In the U.S., the big ones are called Renewable Identification Numbers, or RINs.
RINs, those are part of the Renewable Fuel Standard program.
Exactly. Government regulations mandate that fuel blenders use a certain amount of renewable fuel, and they prove compliance by buying these RNs. Because RNG is considered a highly valuable low-carbon fuel, the RNs it generates trade at really high prices.
So GFL sells the gas, gets paid. Then they sell the green credit attached to that gas and get paid again, potentially even more.
That's generally how it works. The environmental credit value can often exceed the value of the physical gas itself, giving the whole project really attractive economics.
Okay, gas sales, credit sales. What's the third leg of the stool? The third stack?
The third component is more about risk mitigation and avoiding future costs. By capturing and utilizing the methane, GFL is significantly reducing its greenhouse gas emissions from the landfill.
Which is good for the planet and probably avoids potential future carbon taxes or penalties if regulations tighten.
Precisely. It reduces their environmental liability profile. So selling gas, selling credits, and avoiding future environmental costs, that's the triple benefit driving these RNG projects. It adds up to that projected $175 million a year in EBITDA.
You can see why management said these projects offer the best risk-adjusted returns that we have seen in decades. It seems like very visible, long-term, almost government-supported growth.
It really does. It's a fantastic use of their existing landfill assets. Now, the second piece of this sustainability as profit story is EPR, extended producer responsibility.
EPR. Okay, this is gaining traction, especially in Canada, right? Where GFL has deep roots.
Exactly. EPR is fundamentally shifting who pays for recycling and waste management, particularly for packaging.
Instead of taxpayers or municipalities footing the bill through property taxes.
The responsibility and the cost shifts onto the companies that actually produce the packaging and the goods sold in it. Think big consumer brands, food companies, beverage companies.
So the producer pays. How does that benefit GFL?
It fundamentally changes their customer relationship in recycling. Previously, GFL might have had contracts with hundreds of different municipalities, each with its own budget issues, contract lengths, maybe payment delays.
A fragmented customer base.
Very fragmented. Under EPR, GFL increasingly contracts directly with large, well-funded producer responsibility organizations, or PROs. These PROs represent the interests of all those big corporations.
So GFL gets one big contract with a stable organization representing, say, all the beverage companies, instead of dozens of small municipal contracts.
Exactly. They secure stable, long-term fee-for-service contracts to manage the collection and processing of recyclables for these massive EPR programs.
Fee-for-service sounds good. Less commodity risk than trying to sell the recycled paper or plastic themselves.
Much less commodity risk. They're essentially getting paid a steady fee by these large, very creditworthy corporations, the producers, to provide the recycling service. It creates enormous revenue stability, generally higher margins than traditional recycling, and just a much lower risk profile overall.
Does this require investment too? Handling more volume or different materials under EPR?
Yes, to handle the increased volumes and sometimes stricter processing requirements under EPR, GFL is investing capital to upgrade its material recovery facilities, the MRFs. But again, that capital spending is justified because it's backed by these secured long-term contracts from the PROs.
Okay, so you've got RNG leveraging landfills, EPR leveraging recycling infrastructure. When you put those two new sustainability-driven growth engines together, what's the total expected impact on GFL's bottom line?
Management has guided that these two initiatives, RNG and EPR combined, are projected to add somewhere between $270 million and $380 million in incremental adjusted EBITDA during the 2026 to 2028 timeframe.
Wow, another huge chunk of high-margin growth.
Yeah, it creates this powerful second layer of earnings growth that's completely separate from the traditional levers of M&A volume and core pricing. It really diversifies their growth story.
Okay, let's bring it back to that $8 billion sale. It wasn't just about simplifying the business model, right? It was the absolutely essential catalyst for a massive financial transformation. And priority number one had to be tackling that big debt load GFL was known for.
Absolutely. That high leverage was the elephant in the room for years, weighing on the stock price. So the first, most immediate, and most transformative use of that cash was deleveraging.
How much actually went to paying down debt?
Of the total proceeds, roughly $3.75 billion was immediately earmarked and used to repay existing debt facilities.
$3.75 billion. That's a serious chunk of debt wiped off the balance sheet. What does that do for them on an ongoing basis? Just makes the balance sheet look better?
Oh, it does much more than that. It has a direct, permanent, positive impact on their profit and loss statement, specifically on their cash flow.
How so? Lower interest payments.
Exactly. The sources estimate that this $3.75 billion debt repayment will reduce GFL's annual cash interest expense by nearly $200 million.
$200 million a year.
Per year. Every single year. Just think about that $200 million that used to go out the door to lenders now stays within the company. That flows directly into improving their free cash flow year after year without them having to collect a single extra bottle or can. It's a huge structural improvement.
Okay, so massive interest savings. And the point of all this deleveraging is to get their overall leverage ratio down, right? That net debt to adjusted EBITDA number?
Correct. That's the key metric everyone watches. GFL finished 2024 with a net leverage ratio of 4.06 times their adjusted EBITDA.
Which is considered high.
Yeah, for this industry, that's definitely on the high side. It carries a risk premium in the market size. The big goal now, post-divestiture and debt paydown, is to get that ratio down into the low 3.0x range by the end of 2025.
Getting under, say, 3.5x or towards 3.0x, why is that specific level so important? What does that unlock for them, potentially?
Hitting that low 3x range is a major milestone. It signals a new level of financial maturity and stability. Crucially, it puts GFL firmly on the path toward achieving an investment-grade credit rating from agencies like Moody's or S&P.
Investment grade. That's the gold standard for corporate debt.
It is, and getting there would be transformative. An investment-grade rating significantly lowers a company's cost of capital, meaning they can borrow money more cheaply in the future to fund things like more M&A or those RNG projects.
Okay, cheaper debt. Anything else?
It also dramatically broadens their appeal to a whole new class of investors, particularly large institutional fixed income funds, many of which are prohibited by their mandates from holding non-investment grade or high-yield debt. So it just opens up a much wider pool of potential capital.
Right, so deleveraging was priority one. Now that they have this cleaner balance sheet and strong cash flow, what's the new plan for allocating capital? The old GFL seemed to be all about growth at any cost, mostly fueled by debt. What's the philosophy now?
It shifted significantly towards a more balanced approach. Management has laid out a very clear hierarchy of priorities reflecting this newfound financial flexibility and maturity.
Okay, what's the pecking order?
Priority one was that massive debt reduction we just talked about. Get the balance sheet right first. Priority two is funding organic growth, specifically those high-return, high-visibility sustainability projects, the RNG and APR investments. That's earmarked for about $325 million in growth capital expenditure for 2025.
Okay, delever first, then fund the best internal projects. What's priority three?
Priority three is keeping that M&A engine humming, continuing to deploy that $700 million to $900 million annually on those accretive tuck-in acquisitions, which is still a core part of their growth algorithm.
Right, bolt-on growth. And then priority four. This is the big change, isn't it? Returning capital to shareholders.
This is probably the most significant signal to the market about the new GFL. Priority four is shareholder returns. With the deleveraging largely done and growth funded, they initiated a massive share repurchase program.
Massive.
They allocated up to $2.25 billion of the proceeds from the environmental services sales specifically for buying back their own stock.
$2.25 billion for buybacks.
Yep. And they moved fast. In just the first half of 2025, they reported repurchasing over 35 million shares.
Wow. So management is basically saying, our stock is cheap, and the best use of this cash right now is to buy it back.
That's exactly the signal. It's a powerful statement of confidence. It's also mathematically accretive, meaning it increases earnings per share for the remaining shareholders. It tells the market, we believe in the value, and we're actively going to support it while generating returns for those who stick with us.
Okay, that's a compelling picture. Deleveraging, funding high-return projects, still doing M&A, and big buybacks.
Yeah.
But we have to inject a note of caution here, right? This is still a very capital-intensive business. It costs a lot just to keep the wheels turning.
That's the critical reality check. You absolutely cannot forget the capital intensity. Waste management requires constant, heavy investment just to maintain the existing asset base. The trucks wear out, landfill cells get filled, facilities need upgrades.
So while they generated, what, about $820 million in adjusted free cash flow in 2024?
$820.3 million, yeah. A good number.
A lot of that cash flow has to get plowed right back into the business just for maintenance.
A very significant portion. Management is working hard to improve their free cash flow conversion rate. That's the percentage of their EBITDA profit that actually turns into usable free cash flow after all capital spending. They're targeting getting that conversion rate up into the mid-40s% range.
Which should be good. Align with the best peers.
Yes, that would put them right up there with the best-in-class operators like Race Connections. But reaching that requires discipline because the underlying maintenance needs are huge.
How huge? How much does it cost just to stand still, essentially?
The required maintenance capital expenditure, or maintenance CapEx, is substantial. For 2024, GFL guided that number was somewhere between $850 million and $900 million.
$850 to $900 million just to replace aging assets and keep capacity flat.
Exactly. So roughly 55% to 60% of all the cash generated from their operations gets immediately reinvested just for maintenance.
Okay, that really underscores why closing that margin gap, getting those RNG profits online, and achieving those $200 million interest savings are all so critical. They need every bit of extra cash flow they can generate to fund the growth initiatives and the buybacks after covering that massive maintenance bill.
Precisely. It highlights the importance of execution on all fronts. So, look, the transformation story is definitely compelling. Cleaner balance sheet, focused operations, multiple growth levers, but it's not risk-free. This industry is complex, and there are always persistent risks, especially around compliance and just plain execution.
Yeah, let's talk risks. The biggest operational one for any waste company has to be the landfills themselves, right? They come with a massive long-term environmental baggage.
Absolutely. GFL operates in a heavily regulated industry. Any misstep on compliance, environmental permits, safety rules can lead to huge fines and operational shutdowns. And specifically with landfills, you're right, the liability is enormous and lasts for decades after the landfill closes.
Closure and post-closure costs, like monitoring groundwater forever.
Exactly. They have to set aside funds for capping the landfill, managing leachate, monitoring gas. It's a huge long-term liability. In fact, GFL had over $1 billion recorded on its balance sheet at the end of 2024 just for these future landfill care costs. Managing that liability effectively is a critical ongoing operational challenge.
Okay, landfill risk. What about internal risks? You mentioned execution. Integrating 270 companies can't have been perfectly smooth.
No, the integration risk is definitely ongoing. Despite having that dedicated enterprise transformation team, there's always the risk that they fail to fully capture the expected synergies from all those acquisitions.
Meaning the cost savings from route optimization or centralized purchasing don't quite materialize.
Right. If that happens, then the M&A engine just added debt and complexity without the promised margin improvement. And beyond integration, safety is just a huge factor in this business.
Truck accidents, injuries at facilities.
Yeah, operating heavy trucks, handling potentially hazardous materials. It's inherently dangerous work.
Yeah.
A poor safety record doesn't just hurt people. It drives up insurance costs, can lead to operational disruptions, and makes it harder to attract and retain workers. It's a constant focus.
Okay, operational risks. What about financial risks? They paid down a lot of debt, but they're not debt-free, are they?
Definitely not. They've dramatically improved the balance sheet, yes, but GFL still carries a significant amount of debt, so they absolutely remain sensitive to changes in the broader economy and particularly to interest rate movements.
Even with the $200 billion interest savings locked in.
Well, much of that is locked in because it related to fixed-rate debt they paid off, but they still have variable rate debt, and future borrowings will be subject to prevailing rates. So an unexpected spike in interest rates could still impact their future interest costs and eat into that free cash flow. It's less of a risk than before, but it hasn't vanished.
Got it. Let's talk about a softer risk, but one the market seems to care more and more about: ESG, environmental social governance. You mentioned the high-return RNG projects, which sound great from an environmental perspective, but how does GFL stack up overall compared to peers in the market's eyes?
Yeah, this is an interesting and potentially important point. There seems to be a bit of an ESG perception gap. While GFL is making these positive moves in RNG, their overall ESG risk rating from Sustainalytics, a major rating agency, is 23.4.
23.4, is that good or bad?
It puts them in the medium risk category. Now, compare that to peers like Republic Services, which scores 16.4, or Waste Connections at 19.6. Both of those are categorized as low risk.
So GFL is seen as riskier from an ESG perspective than its main competitors. Why might that be? Maybe related to that rapid M&A pace historically, or transparency issues.
It could be a combination of factors. Perhaps concerns linger about the integration of so many companies, potential environmental liabilities from older acquired sites, or maybe just a need for more communication and transparency around their overall ESG management practices. Whatever the reason, that higher risk score matters.
How does it matter? Does it actually impact the stock or the business?
It potentially can, yes. Some large institutional investors have ESG mandates that might make them hesitant to invest heavily in a company rated medium risk when low-risk alternatives exist in the same sector. It can also, theoretically, impact their cost of capital over time if lenders perceive higher ESG risks.
So even if the financials look great, this perception gap could be a bit of an overhang, keeping some money on the sidelines or maybe slightly increasing their financing costs.
Precisely. It's another hurdle they likely need to clear through sustained operational improvement and better communication to really achieve that premium valuation they're aiming for.
Okay, and that brings us right to the heart of the investment thesis, doesn't it? The valuation disconnect. Despite this transformation story, GFL still trades cheaper than some peers, particularly Waste Connections.
That's the core argument. If you look at the standard valuation metric for this industry, enterprise value to EBITDA, basically, what the market is willing to pay for each dollar of operating profit.
Yeah.
GFL's multiple, based on its last 12 months, LTM, EBITDA, is hovering around 16.1x. Now, that's pretty much right in line with the larger, slower-growing giants, Waste Management and Republic Services, which are around 16.6x.
Okay, valued like the slow growers. But how does it compare to Waste Connections, the other company known for strong execution?
That's the disconnect. Waste Connections, WCN, commands a premium multiple, trading closer to 22.8x EBITDA.
Wow, 16x versus almost 23x. That's a massive difference in valuation for companies in the same industry.
It's huge, and historically, you could maybe justify that gap because GFL was more complex and had much higher leverage. The market demanded a discount for that risk.
But the argument now is the $8 billion pivot fixed those exact two problems, right? Complexity is gone, leverage is way down.
That's the crux of the bull case. The reasons for the historical discount have been largely addressed. Meanwhile, GFL still has this demonstrably superior growth outlook fueled by ongoing M&A, the pricing power, and those big RNG EPR projects kicking in. Their estimated EBITDA growth for 2025 is in the high teens.
Much faster than WM or RSG, maybe even faster than WCN?
Potentially, yes. And that kind of superior growth profile, combined with the now de-risked balance sheet, should theoretically warrant a valuation much closer to WCN's premium level, not one stuck down with the slower incumbents.
So why isn't the market giving them that higher multiple already? If the story is so compelling, why the hesitation?
It comes down to that classic Wall Street skepticism. It's a show-me-the-money story. The market has heard promises before. Now it wants to see consistent proof of execution.
Proof in what form? What specific things does GFL need to deliver on?
There are probably 3 key metrics the market is laser-focused on. First, they need to prove that the Q4 2024 margin expansion wasn't a fluke. They need to consistently deliver margins in that targeted low to mid-30s range, quarter after quarter, show the efficiency gains are real and sustainable.
Okay, deliver on margins. What's second?
Second, keep walking the talk on deleveraging. Hit that low 3.0x net leverage target and keep it there, maybe even improve further towards that investment grade rating. Prove the financial discipline is permanent.
Makes sense. Margins, leverage.
Yeah.
What's the third show-me item?
Third is demonstrating consistent improvement in that free cash flow conversion rate we talked about. Prove they can manage the high-maintenance CapEx effectively and still generate strong, growing free cash flow that can be used for accretive M&A and those shareholder returns.
So the market's basically saying, we see the potential, but we need to see you actually hit these numbers consistently before we pay a premium price for the stock.
That's exactly it. The skepticism about execution is what keeps the valuation gap open. But, of course, that skepticism is precisely what creates the opportunity for investors.
Right. If you believe management can execute on those 3 things, margins, leverage, FCF conversion, then you potentially get that double play return we mentioned at the start.
Exactly. You benefit not just from the company's strong underlying earnings growth, which should outpace most peers.
But you also get the potential kicker from the valuation multiple itself expanding as the market eventually recognizes the new, improved, de-risked GFL and closes that gap to peers like WCN. That's the potential upside. #TagAnyStory.
So just to kind of wrap this all up, GFL Environmental's huge strategic pivot in early 2025 has fundamentally redefined its entire risk-reward profile. It's a fascinating case study.
Yeah, they basically stabilized the foundation by slashing debt and simplifying the business down to that core defensive solid waste operation.
Right. And now, standing on that stronger foundation, they're set up to grow using 2 really powerful engines.
Engine number 1 is kind of the classic GFL playbook, but maybe more refined now. Still driving superior volume growth through smart tuck-in M&A, but also leveraging that built-in pricing power from the industry's defensive contracts. They've got the growth octane. Now it's about adding that operational polish for margins.
Exactly. And then engine number 2 is that newer, maybe even more exciting layer. The high return, highly visible growth coming from those big sustainability investments in renewable natural gas and extended producer responsibility. That's potentially hundreds of millions in extra high-margin EBITDA coming online over the next few years.
And all of this is now underpinned by a much stronger balance sheet and a capital allocation plan that explicitly includes returning billions to shareholders through buybacks. Plus, you still have a founder-led management team with significant skin in the game.
Yeah, Patrick Davigi, the founder, still very much involved. That insider alignment is usually seen as a positive.
And fundamentally, when you step back, the chance of this business just completely collapsing seems incredibly low, right? Yeah. Given how essential their service is. They're literally the cleanup crew for the economy. Rain or shine, trash needs collecting.
That underlying defensiveness is always key, which really leads to a final provocative question for you, the listener, to think about.
Okay, leave us with something to chew on.
Given everything we've discussed, the highly defensive nature of this industry, the huge barriers to entry, GFL's now proven ability to combine that stability with genuinely superior growth from both M&A and these novel sustainability projects. How quickly should the market reward this transformation?
Yeah.
If they successfully execute on closing that margin gap, hitting the leverage targets, and improving free cash flow conversion, is there really any logical reason left for that big valuation discount to persist? Could GFL rapidly become the industry's next premium valued player right alongside Waste Connections? Or is the execution risk still too high in the market's mind? That's the multi-billion-dollar question.